In this video, we're going to move into the next step of our merger model, which is looking at the projected financial statements, specifically the income statement for both Apple, the buyer, and Research in Motion, the seller. In the introductory video to this course, we said that in a merger model, you analyze the trade-off between purchase methods, cash, stock, and debt, and then the financial profiles of the buyer and seller. And those are the two key factors that you're looking at whenever you have a merger model. Now, in the previous lesson, we looked at some of the key assumptions that will allow us to determine the trade-offs between these different methods of purchasing a company. With those in place, what we need to do now is look at the actual financial profiles of both Apple and Research in Motion. And we have up here some of the basic information such as share price, equity value, enterprise value, and so on. But in a merger model, what we do is we actually look at the income statements of both companies and we combine them. And to combine them, we first need to assess what they look like separately. On the page that you see in front of you, what I've done is I have RIM's income statement. So their income statement for 2010 and 2011 here. If you're wondering where I got these numbers from, because we didn't go over this in detail, below this video, there's a link to this equity research report from Caris & Company, and this is the report that I used to get the numbers from. I use this in conjunction with their historical filings. If you go through, you can see how they're projecting the market growth, and then they get to their financial statements, and they have projections here for revenue all the way down to earnings per share. Now, the only tricky thing here in terms of getting the numbers is that when we look at the revenue for FY 2010, for example, in this report, I'm going to zoom in, we are not just taking the 2010 number right here, because remember that Apple's fiscal year ends in September. So to make this comparable, we want to make sure that our 2010 numbers for RIM are actually the November 2009, February 2010, May 2010, and August 2010 quarters, because that takes us to approximately September. So that's the only tricky part of these numbers, that instead of taking the fiscal year numbers for RIM, we're calendarizing it to Apple's fiscal year by taking November, February, May, and August for the 2010 numbers. The same process applies for 2011, except we have a bit less information to go on here. So that's the basic idea behind how I got these numbers here. I'm not going to go through the calculation in detail because we've already been over this when we looked at the comparable companies and when we looked at Apple in the very beginning, so I'm not going to go over this yet again. Some of the math here also gets tricky because not everything is spelled out explicitly in the equity research, so these numbers are really a combination of equity research plus filings plus some of my own estimates, for example, for stock-based compensation, which is never laid out clearly in the equity research. So that's how we get to the numbers for the seller in most cases. We simply look at equity research, try to find a report in the middle of the range, and just pull all the numbers directly from there. If necessary, then we calendarize the numbers and try to match it up with the buyer's fiscal year, because it's going to make the analysis a whole lot easier, and it's pretty much necessary to match their fiscal years. You have to either match the seller to the buyer or the buyer to the seller. In this case, we've chosen to match the seller to the buyer. So we have RIM's income statement over here, and what we want to do now is actually get to Apple's income statement. And the idea here is pretty simple. We're going to go back to our three-statement model right here, and we're going to be pulling in a simplified version of this. So we're not going to go into every single line item here in detail, but instead what we're going to do is create a summary version of their income statement that has the key items all the way down to earnings per share here at the bottom. And actually, for this one, I'm going to let you go ahead and do this. So for your exercise in this video, I want you to actually pull in all these numbers directly from Apple's three statements. Now, for some of them, we can actually do the calculation here, and sometimes we'll need to pull in the numbers directly, and then sometimes we'll be not pulling in the numbers exactly, but summing up some of the numbers on the income statement, for example. So it's not always going to be directly pulling in the numbers, but to get some practice with this and to get practice with the concept of creating summary income statements as we are right here, I want you to go and start with revenue and then go all the way down to net income, earnings per share, and diluted shares outstanding, and get all these numbers from the three-statement model that we created for Apple. To start this off, I can pull in the revenue by using Control Page Up to move all the way over, and then going to 2010 for revenue right here. So we have that linked in, and I can just press Alt ESF to copy it to 2011, press Control left bracket, and we see that it's being linked to 2011 right there. So I want you to continue this exercise and finish filling in the rest of these numbers as I've just started with revenue right here. So pause this video right now, give this a shot yourself, and when you're done, you can unpause it, and then we'll go through this exercise together. Okay, good. So here is what we should do to come up with all these numbers. I'm going to start with 2010, and then I'm just going to copy everything over to 2011 so we don't have to link to everything twice. So for cost of goods sold, I'm going to go all the way over and pull the cost of goods sold for 2010. Gross profit, I'm actually going to make the calculation here. We could just pull this in. It doesn't really matter. I'm just choosing to make the calculation here rather than linking in directly. For operating expenses, so let's go over once again. Remember, we don't want R&D or SG&A by themselves. We want the total operating expense number right here. Then for depreciation, amortization, and stock-based comp, we're going to go all the way over once again and take the numbers from right here. I can actually copy this down, and we see that all of these are being pulled in correctly. Now for operating income, once again, I'm going to make the calculation right here. So we're going to take gross profit, subtract operating expenses, depreciation, amortization, and stock-based comp. Now for interest, income, and expense, this one's a little bit different because if we go over to our three-statement model, we see that it's actually 3 lines here: interest income, interest expense, and then other income and expense. So what I'm going to do instead for this one is actually use a sum formula right here, go over to our three-statement model, and then sum up these 3 line items right here for 2010. And we're doing this because we're really just consolidating this onto one line as opposed to listing it across 3 lines as we did previously. For the pre-tax income, we just take operating income and add the interest income or expense right here. For the income tax provision, we could just go over and link directly in from the three-statement model. So we could just link to this number right here. In this case, I'm actually just going to calculate it because later on it's going to help us to keep our model more consistent. So I'm actually just going to calculate the tax provision right here. So pre-tax income times the tax rate of 30%. I'm going to anchor that with F4 because I don't want the tax rate to be shifting around at all. For net income, we're just going to take pre-tax income and subtract the income tax provision. For diluted shares outstanding, I'm going to link to the three-statement model and go down to diluted shares outstanding for 2010 right here. Then finally, for earnings per share, we're going to take net income, multiply by units, and then divide by the diluted shares outstanding right here. Just to check our math quickly, let's make sure that our EPS number here matches what's on the 3 statements. So we have 1159 right here and then 1359. And then on our merger model, we have 1159 right here. To get these for the 2011 column here, I'm going to highlight everything with Shift-Control down arrow key, Control-C to copy it, and then Alt-ESF to paste formulas. So we see here that EPS comes out to 1159 and 1359, so it looks like our summary income statement matches our real income statement on the 3-statement model. So that's really all we do to create the separate income statement for the buyer and the seller for the merger model here. For the seller, typically, if we do not have it modeled out, we just go to equity research and we look at the projections from right there and pull them in as I did over here. Normally for merger models, you don't even care about the historical numbers. It's really just the projected numbers that matter because you're not looking at what it would have looked like historically. You're looking at going forward 1 year, 2 year, etc. What is it going to look like going into the future? So in merger models, you always care about the future as opposed to the past. For the buyer, if we've done modeling and we have a model, we can just link in directly as we did right here. Otherwise, if this were just a random company and we did not have a model for it, we would do the same thing that we did for the seller. We would just look at equity research and use that with our own estimates to come up with all these numbers. Now, you might be wondering, if we have these, why is it that we're not looking at balance sheet projections? Why is it that we're not looking at cash flow statement projections for both companies? Because in a merger model, you presumably combine everything and you want to see the impact of all of those. And the answer is that most of the time with a merger model, you really care about the EPS change, the change in earnings per share for the buyer. So the balance sheet and cash flow statement can be useful to look at, but not nearly as useful as the income statement. Later on, we will be combining the balance sheets for Apple and RIM, and you can see the setup for some of that right here. So we will be doing that later on, but in general for merger models, you don't really care about balance sheet projections or cash flow statement projections quite as much as you do with income statement projections. And also in interviews, you're not really going to get questions on those topics. You're going to get questions more on combining the income statements, looking at the income statements, making changes to the income statements. So most of the interview questions you get will be focused on the income statement for the buyer and seller as opposed to the balance sheet and cash flow statements. So that's how we set up the income statements for Apple and RIM in this example. Coming up in the next lesson, we're actually going to be combining these income statements. So we're going to be taking all of Apple's financials over here and then all of RIM's financials over here, and we're going to be combining them and then seeing what some of the acquisition effects from using cash, debt, and stock are and how they actually impact the income statement.